Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh, and good afternoon, everyone. This is our usual briefing on global and domestic economic developments for the first quarter of this year. Growth across major and regional economies have slowed significantly as the rapid spread of the COVID-19 pandemic prompted widespread implementation of containment measures. In the advanced economies, the broad-based moderation was driven by a sharp deterioration in private consumption as labour market conditions worsened. Growth in the regional economies was affected by adverse external and domestic demand conditions amid selected implementation of lockdown measures. Nevertheless, the policy responses from major and regional economies have been both large and timely and will help to mitigate the degree of the downturn. Most economies introduced lockdowns in the first quarter this year, with the exception of Singapore and Japan. This has resulted in a sharp and sudden drop in economic activity. Similarly, in Malaysia, we saw contractions in the manufacturing IPI and index of wholesale and retail trade in March. However, the steady expansion in January and February provided support to the overall first quarter growth. Similar to other countries, Malaysia's GDP growth moderated sharply to 0.7% in the first quarter of 2020. The significant moderation was due to slower economic activity following measures to contain the COVID-19 pandemic globally and also domestically. The COVID-19 pandemic, along with the measures implemented to contain its spread, particularly the movement control order, resulted in weakness across most sectors. The services sector moderated sharply in first quarter, the slowest since the second quarter of 2009, as tourism, consumer, and business-related activities were adversely affected. In the manufacturing sector, growth moderated further due to production capacity constraints and weaker external demand. Growth in the construction sector also declined due mainly to a complete halt of projects during the MCO period. Besides the MCO, commodities production remained in contraction. For agriculture, the sharper decline was due mainly to lingering weather and fertilizer-related disruption in oil palm yields. Meanwhile, the mining sector was affected by the ongoing maintenance work and the gas pipeline incident in East Malaysia. On the demand side, growth was weighed by a deterioration in external demand and slower expansion in domestic demand. Sharper contraction in exports there's also sharper contraction in exports reflecting weak external demand. And while private consumption moderated, it remained resilient, supported mainly by spending on necessities. Investment growth, however, declined further due mainly to weaker conditions and movement restrictions. The current account surplus of the balance of payments widened to 9.5 billion, or 2.6% of GDP in the first quarter. The primary income deficit decreased sharply to 6 billion compared to 15.2 billion in the preceding quarter, on account of lower investment income accrued to foreign investors in Malaysia. Given lower tourist arrivals and average spending, the services account registered a larger deficit of 8 billion ringgit. Meanwhile, the goods surplus narrowed to 28.9 billion ringgit as the decline in the level of exports outpaced that of imports. Headline inflation remained modest in the first quarter, averaging at 0.9%. For 2020, average headline inflation is likely to turn negative, largely to the projection of significantly lower global oil prices its trajectory will be dependent on global oil and commodity price developments, as well as evolving demand conditions. Underlying inflation is expected to be subdued, reflecting projections of weaker domestic growth prospects and labour market conditions. As typically is the case during a crisis, deflationary concerns have been raised by some quarters. First, it is important to understand what deflation is. It is not just about negative inflation on its own, but we need to have sustained and broad-based declines, which usually arises due to a collapse in demand. And although we expect headline inflation to average negative this year, the risk of deflation is limited. The impact of COVID-19 shock on prices across sectors is not uniform. While demand may be lower for certain items, it is the reverse for others, such as some food items, making the overall impact mixed and uncertain. And as you can see from the chart, the share of consumer items recording price declines remain at around 20% for the last 3 months. Overall, we expect prices to be supported as demand conditions gradually improve when economic activity resumes. Domestic markets experienced higher volatility during the quarter due to non-resident portfolio outflows as global investor sentiment deteriorated amid concerns over the potential impact of COVID-19. As a result, the ringgit depreciated against the US dollar, the government bond yields increased marginally, and the domestic equity prices declined. Risk aversion, however, has temporarily subsided since April amid policy responses by governments and central banks globally. Going forward, volatility in domestic financial markets will continue as uncertainties linger over the COVID-19 pandemic. The bank will monitor market developments closely and continue to ensure that intermediation is not disrupted and conditions remain orderly. Net financing growth was sustained at 4.7%, supported by a higher loan expansion. Corporate bond growth, however, moderated slightly during the quarter to 7.6% compared to 8% in the previous quarter. The higher loan growth was driven by an increase in outstanding business loan growth of 3.4% compared to 2.4% that was recorded in the fourth quarter of 2019. This was mainly contributed by the electricity, gas and water, and education, health, and other sectors. Disbursement growth outpaced repayments in these sectors. However, household loan growth moderated from the previous quarter. It grew by about 3.8% compared to 4.7% in the fourth quarter last year. This was due to higher loan repayments, particularly on loans for the purchase of securities. The banking system entered this challenging episode from a position of strength. The strong financial buffers, along with sound risk management practices, will enable banks to continue to mobilize deposits and provide credit support to the economy. The banking system, capital, and liquidity buffers remain sufficient to meet any unexpected shocks. Banks' asset quality also remains sound, with net impaired loans ratio of around 1%. In the short run, the loan moratorium will help avert a sharp and sudden spike in defaults, while the relief measures introduced so far will help preserve debt servicing capacity of households and firms over the long run. With the easing of the movement control order, the resumption of economic activity will also lend support to loan growth and mitigate credit losses to banks. Let me now move on to the domestic economic outlook. Since the publication of the bank's 2019 Economic and Monetary Review, there have been major developments that will inevitably influence the growth outlook. First, much weaker global growth outlook as a result of a more widespread and severe COVID-19 pandemic. Second, the longer duration of MCO, which lasted for 7 weeks, as opposed to our assumption of 4 weeks in the EMR. Third, given the imposition of conditional MCO, the mandated health protocols and standard operating procedures are more binding than the earlier assumed voluntary social distancing. Border closures are also expected to continue to be enforced throughout the year. Given the containment measures in Malaysia and globally, we have to expect that the Malaysian economy will experience a sharp contraction in the second quarter compared to the first quarter. Economic activity is affected by the longer duration of containment measures, both globally and domestically. In Malaysia, this includes 4 weeks of MCO and the conditional MCO between 4 May and 9 June 2020. Latest high-frequency data points towards a sharp slowdown in economic activity in second quarter this year. For example, as you can see, data from the Google Community Mobility Report of Malaysia shows a deteriorating trend in mobility changes of certain routine activities as compared to the baseline over the period of February until April 2020. These activities include leisure, shopping, and commuting using public transport. A sharp decline in electricity generation data in April also signifies the slowdown in the economy, particularly business activity. In addition, export performance by regional economies, including South Korea and Chinese Taipei, recorded a larger contraction in April, affirming weak external demand. Labour market conditions are expected to be significantly affected due to the contraction in economic activities. In particular, the unemployment rate is projected to peak in the second quarter as firms undertake drastic measures to cut costs amid longer halt in operations and weak demand. However, with the CMCO, there should be some degree of rehiring as economic activities resume. This should result in a gradual decline in the unemployment rate in the second half of the year. The labour market will also be supported by policy measures such as the Employment Insurance Scheme, the Wage Subsidy Program, the Employment Retention Program, and higher allocation towards reskilling and upskilling programs. These measures should encourage retention of employees, cushion income losses, and promote human capital development. While the commodity sector contracted in the first quarter due to supply disruptions, it is projected to gradually recover in the second half this year. Oil palm production is anticipated to benefit from normalizing weather conditions and higher fertilizer application, encouraged by the strong CPO prices in the fourth quarter last year and the first quarter this year. For the mining sector, the commencement of the Petronas floating LNG2 facility in Sabah and the ramp-up of new fields in Sarawak are expected to provide support to production. Looking ahead, the gradual lifting of containment measures globally will allow for a recovery from second half 2020 onwards. The timely and unprecedented policy responses implemented globally will also help limit the adverse impact of the crisis on economic activity and mitigate widespread scarring effects. In turn, this will support consumer and investor confidence and subsequently demand conditions. Nevertheless, we do acknowledge the extreme uncertainty surrounding the IMF forecast, which depends mainly on the development of the pandemic. Similarly, the Malaysian economy is expected to decline in 2020 before improving gradually in the second half this year and staging a positive rebound in 2021. The gradual pickup in economic activity mainly reflects lifting of the MCO domestically, support from fiscal, monetary, and financial measures, improvement in external demand conditions and tax cycle, and lastly, the continuation in large transportation projects and recovery in the commodities sector. Bank Negara Malaysia will closely monitor these risks and their implications on Malaysia's growth trajectory. In responding to the unprecedented health crisis, a comprehensive mix of policy measures have been introduced. At the recent May 2020 meeting, the MPC further lowered the OPR from 50 basis points to 2%. Since January 2020, the MPC has reduced the OPR by a total of 100 basis points from 3% to 2%. The combined measures of the OPR reductions, other monetary and financial measures undertaken by the bank, as well as fiscal measures implemented by the government, are aimed to cushion the economic impact on businesses and households and provide support to the economic environment. Future monetary policy considerations will continue to be guided by the risk to the outlook for domestic growth and inflation, which remain highly uncertain and are continuously evolving. The bank will utilize its policy levers as appropriate to facilitate a sustainable economic recovery. The bank will continue to conduct ringgit liquidity operations to ensure financial markets continue its intermediation activities across various sectors of the economy. The adjustments in SRR in March and May this year alone by 100 basis points and the flexibility provided to banking institutions to use MGS and MGII for SRR compliance have released approximately 46 billion ringgit worth of liquidity into the banking system. The bank has also injected liquidity through the use of various instruments under its open market operations, such as reverse repos and outright purchase of government securities, which further supported the domestic financial bond market. These combined measures have resulted in additional liquidity of 58 billion ringgit since March 2020. Total liquidity has remained stable around 155 billion ringgit as at end April, with 111 billion ringgit worth of placements with the central bank available to be released at any time. In addition, the bank has also expanded its liquidity facility to other regulators, including interbank DFIs and insurance companies. The bank will continue to closely monitor the liquidity conditions in the domestic banking system and ensure orderly market conditions conducive to support financial intermediation activity. We wish to announce that the 5 billion ringgit special relief facility has been fully taken up by about 9,000 SMEs after its introduction in early March. The facility is expected to support 200,000 jobs in SMEs across all states, sectors, and growth stages. The SRF beneficiaries include SMEs in the tourism industry, those running budget hotels and travel agencies, young SMEs with less than 3 years in operations, and also SMEs who are not existing customers of banks, contrary to earlier reports. The demand for the SRF has been strong, and banks have approved more than 21,000 applications amounting to about 10 billion ringgit up to 4th May this year. Given the exceptional demand, we have upsized the SRF to 10 billion ringgit. At the same time, the banks are also continuing to support lending to SMEs. A total of 62 billion ringgit was disbursed by banks in the first quarter this year alone. We can expect this to continue, and this will further be complemented by additional guarantee coverage by SJPP through the newly launched government guarantee scheme Prihatin worth 5 billion ringgit. Beyond SRF, SMEs can also access financial assistance from a wide variety of sources. There's BNM funds for SMEs, where there's still about 3.4 billion that is still available. And collectively, more than 10 billion ringgit is available from existing government financing schemes and assistance programs, including those channeled through development financial institutions. Alternatively, SMEs can also access financing options through the IM SME platform, which helps to match financing needs with a variety of fund providers that caters to SMEs. SMEs may wish to visit the SME info website administered by the SME Corp Malaysia to get more details on specific schemes or information on other relief measures. Recognizing the need to mitigate the economic impact of the COVID-19 pandemic, the federal government has allocated significant fiscal outlay amounting to 36.7 billion ringgit, or 2.5% of GDP, towards the economic stimulus packages. A substantial portion of this expenditure was directed towards protecting the most vulnerable segments affected from the COVID-19 pandemic through measures such as wage subsidies and cash transfers. In total, these measures are expected to contribute around 0.8 percentage points to growth in 2020. The ongoing pandemic has generated an unprecedented economic crisis. Although lockdowns were initially supply shocks, they had amplified spillovers on demand conditions. Bank Negara Malaysia and the government have put in place a comprehensive set of measures to mitigate the severe economic impact from the pandemic. Importantly, during this period, an effective policy response has to meet three criteria. Firstly, it must be targeted. Secondly, timely. And thirdly, adequate. Malaysia's policy responses will aim to meet this criteria. This includes the deferment on loan repayment and the special relief fund, directly address to directly address the cash flow needs of firms and households. And we also had the earlier SRR and OPR cards that were operationalized swiftly in advance of the full escalation of the COVID-19. And finally, sizable assistance was provided to limit the fallout and to secure a recovery going forward without compromising health goals. While the impact of COVID-19 pandemic is severe, it presents opportunities in the low-touch economy. As in today's press conference, where we are meeting using digital technology, many businesses around the globe will adopt this as part of the new normal. In addition, a rapid growth opportunity, particularly in industries which Malaysia has a significant presence. This includes the E&E and healthcare industries. For instance, Malaysia's strong E&E base provides immense opportunities in the remote working, virtual learning, e-commerce, online shopping, and home entertainment. Our players are also the major producers in medical consumables, such as manufacturers of high-tech medical devices. Structural reforms are key to unlock these opportunities. First, embrace e-commerce and digitalization. This includes automating factory operations through Industry 4.0. Second, reskill displaced workers to be able to perform high-value added functions in new growth areas. And thirdly, position businesses as destination of choice for dual sourcing opportunities. This marks the end of the presentation.